All right, everybody, welcome back to another video here on the Dividend Doggo Show on YouTube, and I am bringing you into the weekly portfolio review where we are going to take a look at everything going on with the portfolio over the course of the last week. So I wanted to start out with the all-time view. You can see that all-time gains were still up a little over $104,000, almost $105 in market gain total. That is just the capital gains for the stocks that I hold in this portfolio. And then we have about $48,500 in earned dividend income. So it's about a 2-to-1 ratio there of capital gains to dividends, which is pretty wild because this was significantly higher. Just a couple months ago. If you look at April 8th, we were hitting peak all-time highs at 775,000. So this portfolio has fallen quite a bit over the past couple of months. So let's dial it down and look at the 1 quarter. We're down about 9% or $72,000. And we earned $6,600 in dividends over the last quarter. Now, that is absolutely staggering. For most people, that would absolutely terrify them. And the main reason being is that there's so much volatility. It makes you uncertain about wanting to keep investing your money, because most of the money invested in this account is money that I put into the account. And it's taken years to build up the passive income to the point where I was able to fund this account so rapidly. So it's one of those decisions that's very hard when you're going to be putting in more money. Now, the main reason that I haven't been putting in more money isn't because of the fact that there's volatility in the market. I like this volatility with it going down because it allows us dividend investors to buy our dividend stocks at higher yields, get more for the money that we're putting in, especially when we're doing quality companies and we're buying assets that we want to try to hold for a long-term investment. Now, for me, I'm in my 30s going into my 40s. It's gonna be, supposedly those are times where you're supposed to be earning more money than ever before, and I want that time period to be a high savings rate, and I want us to be able to put forward more money into investing so that we can potentially live off of that and coast through our 50s without having to have the stress of working full-time just to make the money to pay for our basic living expenses, which have drastically increased over the past few years. So with inflation and everything going up, it's definitely one of those big concerns overall. So let's look at the 1 month here. You can see that most of the losses for the quarter actually occurred in the last month. Market gains were 66,000 in the red, almost 67,000, and earned dividends in the last month were about $1,700. So let's go ahead and bring it into the week view. In the last week, we lost $32,296.40 in market gains. We did earn $1,300 in dividend income that's going to come into the portfolio in the next 28 days or so, and we're going to be deploying that into stocks as they're gone down in price. So looking at the 1 week here, you can see the Fed announcements that they're raising it about 0.75 of an interest percentage point. Didn't go over well with the market. A lot of things are down. Utilities down pretty significantly. I'm going to take a look at that. Let's go through each of the sectors in the portfolio. As you can see here, finance was down 7,800, almost 7,900. We did earn a tiny smidge of dividends, $12. I believe that's from T. Rowe, maybe. I'm not 100% sure. I'm pretty sure that's T. Rowe. So overall here, you can see it was down across the board, but wow, Ally Financial got slammed this week so hard. The pessimism around this stock being able to weather the overall looming recession that everyone's fearing and worrying about definitely hit home this week. this is crazy that this stock has crashed. This is definitely up there now with Baba in my worst timing to purchase stocks ever. So let's look at this here real quick. I bought this stock at $51.60. It is down $20 from that point. It's like absolutely staggering how much it's fallen there. The interest rate has gone up, or sorry, the dividend yield has gone up to 3.32% on this stock. Am I going to be buying more and adding to this position? It's definitely on my short list to add to, as its cost basis is now so far down below that I'm actually tempted to tax loss harvest this stock and just eat the losses, because the losses total are about $11,000. As most of you know, about a week or so ago, a little over 2 weeks ago now, I sold large positions in 2 other stocks at a very high capital gain rate. So I may actually tax loss harvest out of Ally Financial temporarily and then rebuy back in if it continues to keep dropping at the pace that it is. I'm obviously going to be picking it up at a much higher yield. So that is something that's on my radar, and I'm keeping in my head as something that I may want to do here. Again, this may also be the case with Citigroup. If this continues to keep going down, then I might be watching that. It's not down anywhere near as bad as Ally is, though. So that is an opportunity that I'm looking at for tax purposes. So overall, finance sector got hit pretty hard, but consumer sector got hit just as hard there, being down almost an average across the board of about 6%. When you average everything out, it's 5.24. We earned $1,200 in dividends. I believe that's from Altria. And we had everything come down about 8,300 total for the week. So as that money comes in, I will likely be looking, as Altria is coming back down in price, I might actually go ahead and reinvest that dividend, but I'm going to be keeping that on the side for a little bit and see how the next couple weeks keep going. If we kind of have a flat trend or a little bit of an uptrend, I may try to deploy that money a little bit quicker. Now, looking at this across the board, from Altria being down 5, almost 6%, Coca-Cola 2.5%, Home Depot 6.4%. Now, I was buying Home Depot and it was, expensive, and I knew it was expensive. Same with Costco. These stocks are just core fundamental stocks that I want to hold in my portfolio. And if they keep going down, they're definitely on my radar to add to, as well as Target, Lowe's, Pepsi. These are all very high quality companies, and people aren't going to stop repairing their houses and doing stuff. Like, they're going to continue to try to find ways to cut costs by doing home repairs themselves, and making things a little bit cheaper by making these Home Depot runs and stuff like that. So I think that they will weather the recession, if we have one, pretty significantly. Most recessions generally last less than 2 years. So overall, this may be the best time and best opportunity that I have in my life to be able to invest money into some of these high quality companies. So keep in mind their evaluations and their fundamentals when you're looking at these stocks. Now, Coma Money Pie was down quite significantly, with Berkshire Hathaway being down 8%. I think this is a little bit unjustified, it getting hit this hard. I think that this should have been down a little bit less, but overall, again, these are quality stocks that I want to hold. SCHD is one of the best stocks you can buy, being a high quality index fund that tracks dividend companies that have paid a dividend and grown their dividend over the course of, I believe, more than a decade. So this is definitely something that I will be looking at to add to over time. Those are just 2 high quality stocks. Now, we're going to get into healthcare here. I'm not saying that I timed the market exceptionally well, but You can see that the drop happened here around June 7th. This is where I took money out of AbbVie. It has fallen really significantly over the past couple weeks. And if we look at this, 1 month it's down about 10%, but 1 week it's down 3%. I think taking the profits out of AbbVie while it was high was something that I should have done when it was even higher, because it reached 170s, and I should have likely taken that out a little bit sooner there. So overall, that's something that I should have been keeping an eye on a little bit more. I need to set kind of goals for stocks when they get out of whack, where they're just significantly higher than what I purchased them at, or they're like a double up or a triple up. I need to just take some profits out of those stocks and look for more value plays. I'm very happy that I did go ahead and take some of that money out for other projects and potentially redeploying it back into stocks as they continue to go down. Now, utilities, this was a whopper this week. Vistra had a horrible week. I believe they're having a pretty massive sell-off. I'm not exactly sure why it's being sold off as much. It's likely that they're expecting enhanced costs for natural gas. They, I believe, had locked up contracts because of Uri last year. They had done a whole bunch of contract work to secure natural gas funding through summer into winter. And I believe that was through 2023 or 2024. So I believe a lot of their contracts were already pretty tight. So I'm not sure that this 12% drop over the course of the week was really warranted. And you can see that it was mainly off the back of Monday, Tuesday, Wednesday, and then into Thursday. It was just down really, really significantly. So Duke was also down. I think a lot of the utilities are getting slammed right now. Duke being down 9%. This is one that I had not put a whole lot of money into, but this is a 4% dividend yield. And as this comes down even more, I may be looking at that to add a little bit more to that particular stock. I do like Duke Energy. I've had it for, I want to say, like over 2 years. If I look at this all time, this will tell me here. Yeah. So when I started the portfolio, I started with $285 in Duke in August 6, 2019. So day one, I've had Duke the entire time, and I added significantly to Duke in, was that August 5th of 2020. So obviously prices had come down pretty significantly then, and Duke overall is still in the green both on market gain and earned dividends. This, even with it coming down significantly over the past week, it's still one of those stocks where it's right above my cost basis. I'm gonna keep watching that, and if it does keep going down, buying these stocks and getting like a 4.5, 5% yield on some of these guys is pretty wild. Like looking at T. Rowe Price, its earnings may come down a little bit over the next year, but overall in the interim, you're likely going to maintain their, I'm pretty confident they'll maintain their dividend. If they don't, then that's another reason to look at them and potentially cut that out. However, another one that was down this week was BST. This is the last of the monthly stocks for the dividend category that I have here. I had sold off a lot of these stocks in the monthly dividend pie, mainly for tax reasons at the end of last year. BST is one of those that it tracks the tech stocks, and if tech stocks are going down significantly, it's going to trend down as well. And BST is at an absolutely absurd dividend yield. I think that this may actually end up coming down pretty significantly over the next couple months. I'm going to see exactly how it performs before I want to add more to it. However, this is very deceptive because of the large stock dividend payout that they did, I believe, in December of last year. They pay a special dividend from time to time when there's extra money there. So that is something to keep in mind. My cost basis is about about $40. Well, it's $39.99. We'll call it $40. This coming down $8 a share is making this look more attractive. Most of the people that I know that were buying the stock and definitely were buying it above my cost basis. So this coming down in 1 week, 7%, is pretty staggering. And if it continues to go down, that's something that I'm definitely going to be keeping an eye on. Because adding to this is a long-term capital gains payout, so that means that it's not like it's considered a qualified dividend payment because of that factor. So overall, I'm definitely going to be watching this one a little bit to see about adding to it. The owner's rewards pie. For any of you, if you're new to the channel, we've gotten tons of new subscribers and the growth has been phenomenal for the channel. I want to explain this pie real quick. This pie is set up specifically to get the rewards from the M1 Finance credit card. There was only ever about $800 invested in this pie specifically, so it has come down pretty significantly, about 33% total, so it's lost about $291 in equity gain. I should have properly looked at this and put a lot less money into each of these stocks, but overall the card itself has earned, I believe, about $600-700 so far this year alone. So I'm not too worried about this pie actually growing or making extra money. However, it has thrown off $4 in dividends. I find that kind of amusing. Overall, this pie was down pretty low compared to a lot of the other stocks in the portfolio there. So this is what it looks like. There's Domino's Pizza, Amazon, FedEx, McDonald's, GameStop, Walmart, UPS, Yum Brands. Some of these have changed out the amount that they pay, but for example, I booked a flight just the other day through Delta directly. This gives you a 5% cash return into the portfolio, so it ends up being pretty significant. For the ones that are like 10%, like Netflix, I did resubscribe to Netflix just to watch Stranger Things, and then I'm gonna unsubscribe after just doing the 1 month because the content just isn't there for me. This was relatively low, but this has earned this amount that was put into it back by itself because this is a 10% back. Spotify is the same thing. Spotify has earned back its money easily over the past 6-7 months that I've been using this card. Overall, I don't go to Starbucks anywhere near as much as we used to while we were in Los Angeles. It was really the happening thing to hit a Starbucks. They were all over the place in the neighborhood I was in. There were 2 within walking distance of my apartment there in LA. So overall, eBay is the other one that I've been using pretty significantly. I believe this is 2.5% back. So that is pretty much the structure and what this pie is set up for. You can see that overall it's had a pretty rough time. Most of these stocks have gone down significantly. If I look at Amazon, Amazon is down. This is a money weighted average return, but it's down almost 40% from the time that I was buying this. And I believe that I started buying it, my cost basis was 174 and it's now 106. This is pre-split or post-split numbers, so it was really, really expensive. When I started buying it, I bought it in December of 2021 to set up this card account, and it has gone down rapidly. And Amazon is obviously one of the highest quality companies around, and it's absolutely interesting to see exactly what's going on with Amazon and see it come down this significantly in price. I'm really glad that I don't have a ton of it in this portfolio, but I do have it via index funds in several other portfolios. So I will talk about other portfolios at some point. There's going to be some videos coming out that I think a lot of you have asked for and are going to be interested in. I'm going to showcase kind of what and how and why I structure the 401k accounts the way that I do, and then tell you and show you exactly what's in those accounts, because there's a little bit more than what's in this account in 401k funds as well. I do have an IRA that I've shown off here on M1 Finance as well, which if you've stuck with the video this far, I will show you exactly what that looks like. So this is a traditional IRA account that I set up quite a while ago. I believe, yeah, this was rolled over in October 15th of 2020. And it did some growth. It went up pretty significantly there when I deposited funds for the year all at once. And then I made the investment in Baba in, what was this, August 24th of 2021 with about $30,000. This was at a price point of 171 a share, and this has gotten really low. It's actually come back up a little bit, which is nice to see, but overall it's done nothing but go down and spike back up a little bit and then go down, spike back up a little bit, and we're kind of back on a little bit of a rotation up and down right here again. So this was not smart. I should have left this invested like I do all the other retirement funds in index funds. This was definitely a mistake. As you can see, it's down 40% on the money weighted average return, down $11,771, of which the gains total when this was in at 29,000, I have only put in about 18,000. I've only been growing this particular traditional IRA for right around 3 years. So this has had about $18,000 put into it. So right now, as of today, I'm only actually down about $1,000 of my money. However, I did lose, almost 11,000 total. So about 11 grand that was gains on the money that I had earned over the course of 3 years. So this is something to keep in mind and learn from my mistakes. It was clearly a mistake to rotate this money into Baba, thinking that it was going to rebound some, because it was down significantly once it was at the 171. I don't think anyone could have predicted that it would go to like $70 a share at its lowest point. So it's going to be interesting to see this kind of go through. I know that I've talked with some of you before in the past. If you're newer to this channel, I've made a lot of money off of Tencent. We still hold about 3,700 shares of Tencent. And we also hold JD.com because of Tencent paying out those shares. So I do have some investments overseas in China. So keeping that in mind, this wasn't as scary for me because I'm also a younger investor. I can afford to let this sit and leave it there. Now, that being said, I have not added my 6,000 for 2022. I'm going to be doing that, and that money is going to be index fund into SCHD. I'm just going to keep that going, and if this ever comes back to being even, I'm going to immediately rotate it over into SCHD. That is the current plan. So you got a little bit of a bonus there, and I wanted to kind of showcase the mistakes that I've made, as well as making sure that you understand the risks that you're taking when you're investing in stocks. Things can go to zero. It is possible, absolutely possible. So keep that in mind when you're investing. Continue to invest in broad-based index funds and go from there. You can see I do have several other accounts in here. My cousins, I set up an account for each of them last year, and I've been investing in SCHD for them a little bit every month or every other month. As we have extra funds, I just put a little bit of money away for them. They are teenagers, and it is going to be helpful for them to see when they turn 18 and they either go to college or they go to get a job. They'll be able to see years of growth in what investing has done for them, what dividend payments have done for them. And the reason that's important is because for me, I didn't have anyone to show me and teach me this. I have had no one to really guide me on the journey through stocks other than watching YouTube videos, which is kind of an interesting thing. I watch a lot of PPC Ian, Joseph Carlson, who this portfolio is pretty much modeled after. That those are people that I really like to watch and engage with, to see how they're doing it, what they're doing. One of the biggest problems I've had with investing in the stock market is when to take gains, and I'm trying to be better about that, and that's partially why I'm very ecstatically happy that I took money out of VST and out of AbbVie when I did, because those stocks were massive gains. In for VST, it was a very short period of time, just over 1 year. I did not expect the stock to not only recover but hit all-time highs in just over 1 year. So taking the money out, it was long-term capital gains. I will owe some taxes on that if I don't figure out doing some tax loss harvesting from other positions. So that's kind of where I'm at for the week. I hope that you found this video informative. I hope that seeing my journey here on YouTube and my goal of hitting financial independence of about $80,000 a year in passive income helps everyone figure out exactly what they want to do to try to build something for themselves and some security net, so that if you do lose your job, you have passive income rolling in, every month, rolling that money in, and you can decide whether you need to reinvest that money, those dividends, and you can decide if you need to pull them out to pay your mortgage or pay an electrical bill or pay for a repair for something. You've got that little security net there, and building that is really important to me. So I hope that all of you find this important, and just building financial security for yourself, whether you plan to FIRE and retire early, or you plan to just work your entire life until you're 65, 67, 70. My uncle just retired this year, and he is 73, I think. He worked really hard all of his life, and I just can't believe that's the age of retirement. Like, I feel like I'll be lucky if I make it into the 70s, and I want those years, the later years of my life, to be where I engage and do fun things and get to go on trips with family members and spend money creating experiences in life that I will be able to look back upon and be like, yeah, we went and did those cool things, or we went to this event, or we went to this charity event, or we were able to help X amount of animals. And I'm really looking forward to those things. So that's some of the mindset and motivation for me. Look into where you're putting your money. The best thing you could do right now is just dollar cost average into the market as it's going down, because no one knows when it's just going to rapidly go back up. Last 2020, everyone thought that was going to be recession for 2 years, and it was done in a couple months time frame, and then everything skyrocketed up, and people who invested heavily during that time frame were very highly rewarded. So my suggestion is to look at what you're buying, make sure that you're looking at index funds, and just, if you're not going to put the time into finding value stocks to purchase, then you need to make sure that you're looking at those index funds and putting the money in there. Something like VU, VTI, SCHD is one of the highest quality ones. SCHG, there's even international funds, I believe it's SCHY. Look at those index funds and decide that you want to make a pretty balanced portfolio investing in those, and figure out what your goals are for your money going forward. My goals are pretty simple, and I want to make $80,000 a year in passive income through this portfolio, and it's going to have to be kind of a mold of real estate assets as well. So I'm looking forward to bringing you some more content on that front as well. And we're going to talk about 401k funds and where everything's invested for me in the very near future here. I'm trying to figure out how I can showcase all of that with removing information and not having personal information exposed. So I will talk to you all in another video. This was very long-winded. This is why my longest video. If you made it to the end of this video, I greatly appreciate every single one of you. And I hope that you all have a fantastic weekend. Thank you very much for watching. And Dividend Doggo signing out. I'll see you in another video here very, very soon.